In this next lecture, we're going to go a little bit deeper into how money and banking elements begin to interact with the macroeconomy to create monetary policy, and how bank regulation and monetary policy work together to impact the macroeconomic environment of focusing on the United States. So this has got 5 sections. The first one is going to be a discussion around the Federal Reserve banking system and central banks generally. And again, there's a number of world central banks: European Central Bank, Japanese Central Bank. Bank regulation and how that works, how a central bank executes monetary policy, and this applies to any currency issuing central bank, not just the United States. Monetary policy and economic outcomes, how monetary policy begins to interact from a economic perspective to drive economic outcomes or influence economic outcomes, and then pitfalls and challenges of monetary policy. This is a picture of the Fed headquarters in Washington, D.C. Some of the most influential decisions regarding monetary policy in the world, not just the United States, that's what the slide says, but really in the world, are made behind those doors at the Fed in Washington, D.C. The United States is essentially the reserve currency for the world. It is the currency by which most other currencies are measured, compared, and if in doubt, the U.S. dollar tends to be the flight to safety for most other currencies. So what the Fed does has global impact. So what's a central bank? You've heard me talk central bank a couple times. Central banks are the organizations responsible for conducting monetary policy and ensuring that a nation's financial system operates smoothly. In the U.S., the central bank is called the Federal Reserve Bank, or the Fed. It's semi-decentralized, so in theory, the Fed operates independently of Congress and the President in setting monetary policy. It's not supposed to be heavily influenced by either the legislative or executive branches. It mixes government appointees, so the President appoints the Fed governors and the Fed chair. However, they don't sync up with the presidential elections, and it generally requires a really heavy hand in order to fire a Fed governor or a Federal Reserve chair. The Fed is run by a board of governors, which are 7 members that are appointed by the President of the United States on staggered terms and confirmed by the Senate. So when a new president comes in, generally the new president is going to inherit a set of Fed governors that were appointed by their predecessors, and those Fed governors will serve and kind of roll on and off during the course of a typical 4 or 8 year administration. Current Federal Reserve chair is Jerome Powell. There's a picture of Chair Powell. It's kind of been funny because I think 6 of his 7 last press conferences, he's worn a purple tie. They're trying to understand if does a tie symbolize something. So again, the Federal Reserve chair is so important that people look at what color tie he wears to try and figure out if that means that they're going to be raising interest rates, lowering interest rates, etc. The chair of the Federal Reserve only has 1 vote. However, kind of like the Chief Justice of the Supreme Court. However, they control the agenda and they control kind of how the Fed comes out to the public, and he's also the one that will tend to spend most of his time in front of policymakers, whether that's Congress or members of the cabinet, working to, I don't want to say coordinate, but to inform around monetary policy. There's 12 Federal Reserve districts in the United States. You can see them here on the map. They are governed by the banks that are located in these 12 cities. So you'll hear discussions around the St. Louis Fed or the Dallas Fed. As a matter of fact, when you look at the supplemental videos that I've attached to these lessons, you'll see like St. Louis Fed has put out some really good videos, and as a result, I've kind of attached those in for you to be able to utilize as supplemental. But you can see kind of how the Fed lays out from a national perspective, with the goal and responsibility of supporting the commercial banks and the economy and understanding the economy generally in the Federal Reserve District. So there's 12 districts. Where I'm sitting right now, up here right near the Canadian border in Washington, we've got the San Francisco Federal Reserve Bank handles all of a lot of the West Coast plus Alaska and Hawaii. It's one of the most influential because of the size of the economies on the West Coast. And then again, you've got the New York Fed, which tends to be a very, very influential Federal Reserve Bank, as well as Chicago because of the financial institutions presence there, and then the Board of Governors is in D.C. So what does the central bank do? Well, a Federal Reserve, we'll talk Federal Reserve, but central banks generally, and I've talked a little bit about European Central Bank and China, Japan, Bank of England, they all have really outsized influence on the global economy. There's 5 or 6 key central banks. They're designed to perform 3 functions. Conduct monetary policy, promote stability of the financial system, and to provide banking services to banks and other depository institutions, and to provide banking services to the federal government. So they don't provide, you can't walk into a Federal Reserve branch and go, hey, I want to make a deposit. They handle deposits and transactions between banks and the government, and for the government. Now, when the Federal Reserve is looking at this entire banking system, they're responsible for maintaining that stability of the banking system. They do that through a regulatory environment. Bank regulation is designed to maintain bank solvency, reduce the amount of risk, and ensure that stability so that you don't have to question whether the bank's going to be open tomorrow and the economy's going to be working. Especially as we've moved toward a much more integrated national and global economy, and much of it is online and electronic. The ability to kind of ensure that those systems are solid and secure is a responsibility of the central bank. Regulation falls into a number of categories. You've got the reserve requirements, which we talked about in the money and banking lecture. You've got capital requirements. Touched on that a little bit, but that's the net worth that a bank needs to have. And then restrictions on the types of investment banks can make. Regulation require that banks maintain a minimum net worth, usually express the percentage of their assets to protect depositors and other creditors. So it's essentially a cushion to make sure that the depositors can get repaid, and that cushion is in the event that those assets, so loans largely, are able to, if they end up with a large loan default, because again, government bonds are going to repay, and reserves are reserves. So if the loans go bad, that there's enough cushion on the liability side to make sure that depositors don't get impacted. In order to ensure that this happens, the Federal Reserve and other government agencies monitor bank performance, and they look at the bank's balance sheets. They do bank inspections. They'll actually go into the banks. They'll analyze the books. They'll do audits to make sure they have positive net worth. They're not taking too high a level of risk. That they've documented their loans properly. That they've got good risk management processes in place, and that if there's any issues, those early warning signs are identified quickly and corrective actions taken. There's a number of regulatory agencies. You've got the Office of Comptroller of the Currency, which is U.S. Treasury, the Federal Deposit Insurance Corporation, the National Credit Union Administration, the Federal Reserve. All have bank supervisory responsibility. In addition to, a lot of states have state banks, and they also have, in addition to this, the state banks will have state regulators as well. I touched on this a little bit in the money and banking section, but you can have situations where there's a bank run, where depositors race to the bank to withdraw their deposits because they think that they're going to be lost, because they're concerned that cushion of bank net worth or kind of that equity cushion is gone because of bad loans, and so they're not going to get their deposits back. Bank runs happened during the Great Depression because there was no federal deposit insurance, and as a result, folks would go into the bank, they'd try and take their money out, and the bank would run out of money because it was a fractional reserve system, and then the bank would have to close, and it becomes kind of a real mess. Again, it kind of happened at SVB. One of the classic, literally classic movies pushing 80 years old now, is It's a Wonderful Life with Jimmy Stewart. It's a Christmas time thing. Tends to be on. But you see a run on the building and loan, and he's down to his last dollar, and that's what a bank run looks like. And again, that was before FDIC, and so as a result, you had the building and loan almost went out of business. That's what a classic bank run looks like. So if you want to see a bank run, watch It's a Wonderful Life. Touched on deposit insurance. Risks of bank runs can create significant instability in the banking system. Obviously, if a bank runs out of cash, that causes a problem. So to protect against bank runs, Congress put two strategies in place. Both of these really during the Depression, when these became endemic and exacerbated the economic conditions. The first one is they put in deposit insurance, which is an insurance system that makes sure depositors at a bank don't lose their money, even if the bank goes bankrupt. Banks will pay an insurance premium based upon their number of deposits and their financial stability to the Federal Deposit Insurance Corporation, the FDIC. The FDIC will then, it's an insurance company that's owned by the federal government that essentially will then pay back depositors if the bank fails and are not able to get to liquidate the bank in a way that would get depositors whole with just the bank assets. The Fed also serves as a lender of last resort. So it provides short-term emergency loans in conditions of financial crisis. Sometimes the national government will do that directly. So you had situations like during the 2008 financial crisis, you had TARP, Troubled Asset Relief Program, where the government would buy troubled assets or finance a purchase of troubled assets to inject liquidity into the system, lend money to banks. So again, that's the Congress will essentially provide cash if necessary. Not Congress, but the central bank and federal banking system provide that lender of last resort and the deposit insurance to try and ensure stability. So how does a central bank execute this monetary policy? You've heard me talk about monetary policy, which is really the impact of the quantity of money and interest rates on the macroeconomy. So the Federal Reserve's most important function is to conduct the nation's monetary policy. So U.S. monetary policy is set by the Federal Reserve. Monetary policy involves managing interest rates and credit conditions, which influence the level of economic activity. So they can raise interest rates, lower interest rates at what they lend to the banks. They can increase or decrease reserve requirements to increase or decrease the amount of M1 and M2 money supply available. The most common monetary policy tool in the U.S. has been open market operations, which is a central bank buying or selling treasury bonds to influence the quantity of money and the level of interest rates. If the Federal Reserve buys treasuries, it prints money, gives it to the federal government, it gets treasury bonds, which then get paid back. If it sells those treasury bonds into the general market, what that does is it takes cash out of the system and puts it into the Federal Reserve, and basically put it into the Federal Reserve system. The investors now, as opposed to the Fed, own those treasury bonds. When those bonds come due, the federal government has to pay those out of tax proceeds or refinancing. There's a committee called the Federal Open Markets Committee, FOMC, that makes decision regarding open market operations, so purchases and sales of treasury bonds. It's comprised of 7 members of the Federal Reserve Board of Governors and 5 voting members from various regional Federal Reserve banks. So how do the open market operations increase the money supply? Well, we'll start with Happy Bank. So Happy Bank starts with $460 million in assets divided among reserves. So $40 million in reserves, $120 million in government bonds, and $300 million in loans. And then this is kind of showing what happens when the central bank purchased $20 million in bonds from Happy Bank. So what ends up happening is the Federal Reserve says, okay, we're buying your bonds, and you now have to increase your reserves. So you've got, so we're going to buy your bonds. So now your bonds go down to 100, and we add 20 million to the reserves. And so Happy Bank says, okay, that's all fine and good, but now I've got 60 million in reserves, 100 million in bonds, and I need to make some additional loans here because this is, I'm only required to maintain 40 in reserves. So as a result, Happy Bank only wants to hold that 40 million in reserve. So when a Fed buys those bonds, it puts 20 million in here, which then drops, and Happy Bank says, I don't want that in reserves, I want to lend it out. I can't do bonds anymore, so I'm going to make some additional loans. So I'm going to add an additional 20 million in loans here. And then again, going back to that money multiplier effect, that now begins to snowball because this goes into a business or individual's checking account, and then it kind of moves on. So in this particular situation, we now are looking at it with the liability side, and you can see nothing changes, right? So the reserves initially were the original balance sheet of 40, 120, and 300. In this particular case, the Fed is actually going to sell bonds. So it's going, okay, you now have to sell bonds. You now have to buy some bonds from me. So as a result, they reduce the reserves to buy 30 million in bonds. That turns this to 150, but they've got to have 40 million in reserves. So what do they need to do? Well, they need to reduce their lending. So Happy Bank wants to hold 40 million in reserves. They're going to adjust down the quantity of loans by 30 million over time to bring its reserves back to the desired level of 40. A bank can easily reduce its quantity of loans by slowing down or stopping making new loans, and that causes the money supply to decrease. Remember, money multiplier works in reverse as well. So you put 30,000 or 30 million out here. If it's a 10 million or if it's a 10% fractional reserve environment, that's going to pull out potentially $270 million of overall money supply as it kind of cascades through. A second method that monetary policy is the central bank to lower reserve requirements or increase reserve requirements. And we talked about in the example that we used in both the money and banking section, and I just kind of touched on in Happy Bank, we've got a 10% reserve requirement. That's not set in stone, and one of the levers that the Fed can pull in order to be able to impact the money supply is to increase or decrease that reserve requirement. Reserve requirement is, as a reminder, the percentage that each bank's deposits that's legally required to hold as cash in their vault or on deposit with the central bank. So they can also, if they don't want to hold it in cash in their vault, they can go, I'm going to put it in the central bank. Remember I said the central bank's a banker's bank? They can put it in the central bank, hold it there, and then kind of pull that cash back when they need it. The greater the reserve requirement, the less money that is available to lend out. Because when you think about it, the bank has reserves, it has government bonds, and it has loans. If it's got a higher reserve requirement, that means it's got fewer government bonds or fewer loans. The smaller the reserve requirement, the greater the amount of money available to lend out, whether that's lending to the government or whether that's lending to businesses and individuals. The Fed rarely uses large changes in reserve requirements to execute monetary policy. The pandemic was an exception where it really significantly reduced reserve requirements and allowed banks to lend a bunch more to try and keep the economy flowing, and because people were out of work, they might need to borrow more. Because businesses were unable to open, they needed to borrow more to kind of stay in business. So the Fed said, hey, we're going to cut reserve requirements so that you can lend out more, and we'll also kind of backstop some of that stuff too with some of the PPP loans and other things. But we're going to tighten that back up as the pandemic goes away. The third traditional method that the Fed uses to conduct monetary policy is to raise or lower the discount rate. You'll hear a lot of this like the Fed raised rates or the Fed lowered rates. This is really what they're talking about is the Federal Reserve discount rate. The discount rate is the interest rate that's used that the central bank charges on loans that it gives to other commercial banks. So remember, it's a lender of last resort. It also can loan money on an ongoing basis, and kind of move money back and forth between banks that have surplus and banks that have deficit. So that discount rate and the discount window you'll hear is the rate when they say the Fed raised rates. It's generally going to be the discount rate, and then that cascades through the banking system. If the central bank raises the discount rate, then commercial banks will reduce their borrowing of reserves from the Fed and instead call in loans or make fewer loans to replace those reserves. And since fewer loans are available, the money supply falls and market interest rates rise. And again, interest rates are the price of money. So when there's a lot of money out there and there's a high demand for money, the interest rates rise. When there's a low demand for money, interest rates fall. If the central bank lowers the discount rate it charges to banks, the process works in reverse. More loans become available, the money supply rises, and market interest rate falls. So then we've got this concept of, okay, we've talked a lot about monetary policy and interest rates and levers and all that kind of stuff. What does that mean for macroeconomics and monetary policy and economic outcomes? Well, I'm glad you asked, because that's where we're going to kind of start focusing this back down on macroeconomic policies. Expansionary monetary policy, or loose monetary policy, is a monetary policy that increases the supply of money and a quantity of loans and kind of pumps money into the system. A contractionary monetary policy, or tight monetary policy, so when you hear me talk about these two things as we move forward, you'll know, contractionary or tight is a policy that reduces the supply of money and loans. So it's either expansionary or contractionary. And they tend to correlate almost opposite with the way the economy is working, and we'll talk about that in a minute. We talked a little bit about interest rates and the monetary effect of monetary policy on interest rate. You'll hear the Fed funds rate. Fed funds rate is the interest rate at which one bank lends funds to another bank overnight. So sometimes a bank's going to be short a little bit or over a little bit on the reserve requirement because just timing of cash flow. So they borrow or lend money to each other to make sure that they've got enough reserves kind of sitting in their accounts. And so that's the Fed funds rate. The Federal Reserve provides that lending facility, and that's the interest rate at which one bank lends funds to another bank overnight. How does the central bank raise interest rates? It's through open market operations. So the central bank can change bank reserves in a way which affect the supply curve of loanable funds. We talked about that, kind of by forcing bonds to be bought or sold. The Federal Reserve has since '95 established a target Fed funds rate in advance of any open market operations. So it said, hey, this is what we want the Fed funds rate to be, and then we'll use open market operations to essentially force the market in and out of that. If open market operations don't meet the Fed's target, then the Fed can supply more or less reserves. So essentially dial up or down the reserves until the interest rates meet the target. And it's a far more complex system in practice than it sounds in theory. But at the end of the day, the Fed has a number of levers to be able to kind of force interest rates up and down. And let's take a look at it from a supply-demand curve, because this is essentially what interest rates are, as supply and demand of money. So the equilibrium point initially was here. So you have a supply of money. People are willing to lend $10 billion at 8%. And that's where your equilibrium point is. This is the demand for money here. So as interest rates fall, demand for money goes up. As interest rates rise, demand for money falls. As interest rates rise, obviously money supplied, people are willing to lend more. And as interest rates fall, people are willing to lend less. So an expansionary monetary policy, when I talk about expansionary monetary policy, that actually shifts things to the right. So what happens is the supply curve, essentially the Fed pumps money into the system through any one of those levers that it can pull. And what that does, because the supply of money goes up, the interest rate falls because the demand curve hasn't changed, just the supply curve has changed. So as a result, the new equilibrium rate goes to E1. So it basically falls from 8%, $10 billion at 8%, you're now going to be lending out $14 billion at 6%. And you can see that not only has the price of money fallen, but the amount of money in the system has gone up, which then again drives a number of factors, which we'll talk about. But in theory, this is to drive economic growth. Again, if you've got a contractionary monetary policy, you've got the Federal Reserve pulls money out of the system, which will drive interest rates up and reduce the amount that people are willing to lend at those rates, because the amount of money available, the supply of money available, is lower. And the Fed is going to do this when the economy's a little bit overheated and it wants to kind of slow growth down or slow inflation down. It raises interest rates, reduces the amount of money in the economy. That brings inflation down. So what's the effect of monetary policy on aggregate demand? Well, monetary policy affects interest rates and the available quantity of loanable funds, which then affects a number of components of aggregate demand. So tight or contractionary monetary policy reduces two components of aggregate demand. Business investment declines because it's less attractive to borrow money. When you get into a principles of finance class, you're going to learn about kind of the required rate of return on a project or the required rate of return on an investment. That number starts to go up because the risk-free rate goes up. And so as a result, businesses will actually do less. And consumer borrowing for big ticket items goes down. Again, we're seeing that with mortgages. Mortgages went from 3.5%, 3.5% up to 7.5%. The number of houses being traded is going down as a result. And that's, again, both supply and demand is driven by mobility of people in the housing market. And people who have houses with low mortgage rates aren't selling, and people who want to buy aren't buying because the interest rates are high. So the market's kind of seized itself up a little bit. Consumer borrowing for big ticket items goes down. Conversely, which again, if the economy's kind of cranking along and doing kind of great guns, and you see inflation, which is a kind of a byproduct of a overheated economy. When that starts happening, you then see the Fed go, okay, we're pulling that back down. Conversely, looser expansionary monetary policy is going to tend to increase business investment and consumer borrowing for big ticket items. And you saw that during the pandemic, where the interest rates went really low, the Fed started pumping money into the economy, the Congress on a fiscal side started pumping money in the economy, so you had monetary stimulus, you had fiscal stimulus. Bang, you tried to kind of hold the economy running even though a bunch of it was shut down due to the pandemic. We're starting to see a little bit of that overhang now in terms of inflation. That's what normally happens is, that we probably stayed on the accelerator a little bit long. Now we've got some inflation in the system that's going to have to cool itself down. So in A here, an expansionary monetary policy, the economy's in recession at E0. And so, the price levels that let's say a little above 90, and the output in constant dollars is at 600. You're below the long run aggregate supply curve. So as a result, you're showing that you're in a recession. So as a result, the goal in an expansionary monetary policy is to drive, and the goal kind of at a macroeconomic policy level is to drive actual demand to match the long-run aggregate supply curve, so that way the economy's kind of at full employment, kind of full utilization. So how does monetary policy do that? Well, an expansionary monetary policy says we're going to increase, we're going to reduce interest rates and increase aggregate demand from AD0 to AD1, because now interest rates are lower, so that hurdle rate from a required rate of return goes down. It's more attractive to borrow to invest in new equipment or products or new houses and things like that because the money's gotten cheaper. And as a result, aggregate demand shifts to the right. And then you see, again, in an idealized world here, the price level rises. So you've got some inflation, and price level rises from 92 to 100, but real output, so again, this is constant dollars, not inflated dollars, real output also rises back to 700, back to where aggregate demand crosses the long run aggregate supply curve, and now the economy's back at full employment. Yes, you did have inflation here, but at the end of the day, you also saw a kind of a increase in wealth through real output. On the converse, you've got contractionary monetary policy, and this kind of is what happened during the pandemic. So what happened during the pandemic was that the Fed and combination of fiscal monetary policy, they were trying to do this. What they ended up doing was this, which is they kind of overheated the economy a little bit, and so as a result, you went from they went to producing above potential GDP at the output level equilibrium of E0. So kind of as the economy was recovered from the pandemic, but they hadn't pulled back on some of the monetary and fiscal stimulus, we got out here to E0. And then what they're doing now is raising interest rates and affecting contractionary monetary policy to shift aggregate demand down from AD0 to AD1. That's the goal. And that's going to lead to a new equilibrium point, which you'll see some disinflation, so deflation, and back to a sustainable long-run aggregate supply curve. And again, when we talked about the difference between Keynesian economists and neoclassical economists back a couple lectures ago, the neoclassical economist says you may end up here, which is you end up at the long-run aggregate supply curve. Demand doesn't actually fall. We don't force into a recession, but instead all that's happened is you've just created a significant amount of inflation. You've gone from E1 to what would be E2 up here. You're now at 110 or 115 price level, but your real output remains the same. So as I mentioned, it's counter-cyclical. Monetary policy tends to be counter-cyclical, which means it's moving in the opposite direction of the business cycle, and so as a result, you have contractionary monetary policy when the business cycle is going well, and you have expansionary monetary policy when the business cycle is contracting. So that's just kind of something to keep in mind. So expansionary monetary policy. So when monetary policy is going up, we want the amount of money to go up. So your M1, M2 goes up. That lowers the interest rate. That causes additional borrowing for investment and consumption, which causes prices to go up and real GDP to go up. So expansionary monetary policy means more money, lower interest rates, more investment, more consumption, inflation, but real GDP, so real economic wealth goes up even with the inflation. Contractionary monetary policy says we're bringing the money supply down, which causes interest rates to rise. That causes investment to decline. It causes consumption to decline. That will cause prices to decline as we kind of get back to an equilibrium point at the long-run aggregate supply curve. And it causes a recession, real GDP to fall. So this is an expansion, real GDP rises. This is a recession, real GDP falls. So here's the Federal Reserve over the last few decades. Through the episodes here, the Federal Reserve has typically reacted to higher inflation with a contractionary monetary policy and a higher interest rate, and to higher unemployment with an expansionary monetary policy and a lower interest rate. So you can see here's the inflation rate is this dark blue line. This is the Fed funds rate. So you can see that kind of in parallel, it raises the Fed funds rate with the inflation rate, and lowers it as inflation lowers, so that way they tend to correlate. You've got these various episodes, again, episode 10 being the pandemic, where unemployment spiked, and as a result, you see here the Fed funds rate at 0 or near 0 in response to unemployment. You also see that it was held near 0 here during the financial crisis, where unemployment was high, and as it came down, Fed funds rate rose. This is a fairly typical example of that counter-cyclical move that the Fed uses. You'll hear a lot about QE, QE2. QE is quantitative easing, which is the purchase of long-term government and private mortgage-backed securities by central banks to make credit available in hopes to stimulate aggregate demand. It was used in the 2008 recession I talked a little bit about TARP and some of those things where essentially the federal government bought or backstopped a lot of those types of assets. That's been utilized again more recently during the pandemic. Quantitative easing differs from monetary policy in a couple of key ways. The Fed is purchasing long-term bonds rather than short-term bills. So the Fed is basically making a long-term potential lending commitment to the government or to private mortgage-backed securities, and that's the other difference. Is traditionally the Fed has never, or has rarely, made purchases of private securities. During 2008 recession, the Fed bought significant volumes of private mortgage-backed securities to make sure that the mortgage market would continue to function, as most of the lenders and the investors in the mortgage market basically said, we're concerned about the quality of this stuff, we're out. The Fed stepped in to ensure that there was liquidity in the mortgage market. So it sounds like monetary policy does wonderful things, and it's a miracle and all that other good stuff. It's not. There's some significant challenges around monetary policy. The other piece, again, we've talked about fiscal policy as well. There's pros and cons. There's no free lunch in economics. So on a pitfall side, banks are legally required to hold a minimum level of reserves, but no rule prohibits them from holding excess reserves. So as a result, they may go, hey, I want to hold more, which then, as we mentioned, reduces a multiplier effect, which then doesn't have the desired impact on the economy. And the velocity of money can change. So the velocity is the speed at which money moves through the economy. It's the nominal GDP, so it's kind of not the real GDP, but the GDP that's reported, including inflation, over the money supply. So how often does that money supply kind of rotate through the economy? The money supply might be, if the money supply is 2 million and the economy is 20 million, the velocity would be 10. And velocity can be fairly unpredictable. So if we kind of take that velocity formula we talked about here and rewrite it so that the money supply is on the left-hand side over here and the GDP is on the right-hand side. That's called the basic quantity equation of money. And again, I promised you I would not get heavy into math, so we're using simple math, but the concept is important. So money supply times velocity equals nominal GDP. So if they can pump money into the economy, but if velocity falls, it doesn't have any impact on GDP. So this is kind of a basic situation. Or if velocity rises, even if you pull money supply out of the system, velocity rises faster than you're pulling money supply out, nominal GDP can continue to rise, which may cause inflation. Recall that nominal GDP is a price level or the GDP deflator times the real GDP. So therefore, money supply times velocity equals the price level times the real GDP. And look at that equation, you can see changes in velocity can really wreak havoc with monetary policy. And so when consumer confidence, you'll hear this consumer confidence index, and consumer confidence becomes important. When consumers are nervous, they don't spend as much and velocity goes down. When businesses are nervous, the producers say, I'm going to slow down on investment, velocity goes down. So the Fed could be pumping money into the system and velocity starts to fall. That still is going to impact real GDP. So here's velocity, and you can kind of see what happened here with the pandemic and everything getting shut down. So velocity calculated using the M1 money supply. So velocity is a nominal GDP divided by the money supply for a given year. So you can see, back when the economy was kind of cranking along here at just prior to the 2008 financial crisis, we were pushing velocity at 10. And then it fell through the financial crisis and was stabilizing. And it's historically, kind of stabilized in this 5 to 7 range. So velocity is calculated using M1 has lacked a steady trend since the 80s. It's kind of bounced around a little bit. The redefinition of M1 to include savings deposits in 2020 reduced or dramatically increased the supply of M1 in 2020, causing velocity to plummet. And then you have the shutdowns associated with the pandemic will also cause velocity to plummet because people weren't spending. Most central bankers believe that the primary task of monetary policy should be fighting inflation, not unemployment. Their job, as they see it, is not to run the macroeconomy, but to make sure that the money supply, the banking system, are predictable, reliable, and stable. The vision of focusing monetary policy on a low rate of inflation is so attractive that many countries have rewritten their central banking laws since 1990s to have their central bank practice inflation targeting. So they said, the target inflation rate for the European Union is 2%, and the European Central Bank, you're responsible for maintaining that inflation at 2%, whether the economy is going up, down, sideways, etc. Inflation targeting is a rule that central banks are required to focus on keeping inflation low at a specific target, and the other macroeconomic factors are responsibility of fiscal policy. Economists, so central bankers, say, hey, we want to focus on money supply. We're not worried about unemployment. We're not worried about GDP expansion. We're not worried about preventing recessions. We're worried about making sure inflation stays at around 2%. Because again, their argument's going to be if we can keep this at around a 2% increase, and we're keeping this stable, then the focus is basically on velocity at that point, which the Federal Reserve doesn't control, and that's controlled by what's called market forces. And as a result, this is things like consumer demand and consumer confidence and producer confidence, and that's the responsibility of basically the elected officials and fiscal policy. So economists, though, have no final consensus on whether the central bank should be required to focus only on inflation or should have a greater discretion to look at the macroeconomy as a whole. So monetary policy in a neoclassical model, I touched on this when we looked at when I kind of talked through the supply and demand curves as it kind of rolled through the pandemic with increased inflation. In a neoclassical view, monetary policy affects only the price level, not the level of output in the economy. So essentially you force demand up, the long run aggregate supply curve kind of stays where it's at. And so as a result, all you've done is push inflation up. It bounces out here and then it bounces up here. And that happens quickly. An expansionary monetary policy causes aggregate demand to shift from AD0 to AD1 because the long run aggregate supply curve hasn't shifted, and we don't really look at things in the short run as a neoclassical economist. Really all it did was cause an inflationary price pressure here, but it did nothing to address the long run aggregate supply and real GDP.